Welcome back to Talk Tickers. It is Wednesday, February 4th, 2026, and we are right in the thick of earnings season. Today, we are dissecting a report that hit the tape this morning, which, frankly, looks like a paradox. We're talking about Silicon Motion, ticker SIMO.
Yeah, this is one of those prints where if you only read the headline numbers, you might have, shorted the stock.
Yeah.
But if you actually listen to the conference call, you were probably buying with both hands.
Exactly. We have an earnings miss. A legitimate, bottom line miss. And yet the stock ripped, 9% pre-market and closed up over 6%? That is a massive divergence. So our job today is to figure out why. Why is the market forgiving the sins of the past quarter and paying up for the promise of the future?
It's a classic case of better than feared mixed with a really big structural shift in the semiconductor landscape.
Okay, before we get into the structural stuff, which I think is the real story, let's just set the table with the raw numbers. What actually happened in Q4 2025?
All right, let's run the tape. So revenue was the star of the show. They posted $278.5 million for the quarter. The street was sitting at $61.2 million, so that's a significant beat. Year over year, that is up 45.7%.
Whoa, pause there. 46% growth. That is massive for a company that, let's be honest, makes controllers for flash memory. This isn't some software startup. This is hardware.
It is huge. But then you look at the bottom line. Non-GAAP earnings per share came in at $1.26.
And the analysts
They wanted $1.29.
Yeah.
So they missed. They missed by 3 cents.
And usually in this kind of environment, you miss the bottom line. You get taken out behind the woodshed. So why didn't that happen here?
Guidance. It's all about guidance. The market is a forward-looking mechanism, right? Management came out and guided Q1 2026 revenue to a range of $292 million to $306 million.
Okay, I want to contextualize that for a second. We're talking about Q1, January, February, March. In the consumer electronics world, this is the hangover quarter. Everyone bought their laptops and phones in December. Q1 is supposed to be dead.
Dead. Historically, Q1 is down 10, maybe 15% sequentially for this industry. Silicon Motion is guiding for growth, 5 to 10% sequential growth. I mean, they're basically defying gravity.
Okay, so that's the hook. They are growing when everyone else should be shrinking. Let's play devil's advocate, though. Is this just, inventory stuffing, channel fill, or is there something actually changing in the plumbing of the tech world?
It's not channel fill. It's a fundamental change in the competitive landscape. We've been calling this the vacuum thesis.
Explain that. Who left the room?
The big boys.
Yeah.
Samsung, SK Hynix, Micron, the integrated device manufacturers, the IDMs.
Mm-hmm.
For the last decade, they've been the 800-pound gorillas. They make the NAND flash memory, and they make their own controllers to run it, debundle it.
Right, the whole vertical integration play?
But look at what happened in 2025. The AI boom just exploded. Demand for HBM high bandwidth memory. And these high-end enterprise SSDs for AI training clusters, it just went through the roof. And these companies have finite engineering resources, finite fab space.
So they have to choose. Do I make a controller for a mid-range Android phone, or do I make HBM for an H100 GPU?
It's not even a choice. The margins on HBM and AI storage are just astronomical compared to client SSDs or mobile storage. So the IDMs have effectively quiet quit the merchant controller market for client devices. They're reallocating their best engineers to the high-margin AI stuff.
Which creates a vacuum.
A massive one. Handset makers, the Oppos, the Vivos, the Xiaomis, even parts of the PC supply chain, they still need controllers. They can't just stop shipping phones because Samsung is busy with AI. So who do they call? They call the only merchant market leader left standing who has the scale to deliver. They call SIMO.
And that explains the eMMC and UFS numbers. I saw in the report their mobile storage business grew 25% for the full year.
And that is purely market share gains. The total addressable market for smartphones didn't grow 25%. SIMO just took a bigger slice of the pie because the other guys left the table.
So, in a weird way, the AI boom is helping their legacy business, not because they're in AI, but because AI distracted their competition.
Precisely. They are the designated survivor of the controller market.
But here's my concern with that. Being the designated survivor in, let's call it, a commodity market is great for cash flow, but it doesn't get you a 25 or 30 PE multiple. Investors want growth. They want that, sex appeal of the data center. Does SIMO actually have that, or are they just posing?
This is the pivot. The cash from the mobile business is what's funding the R&D for the AI pivot.
Mhm.
And this isn't just marketing fluff. They're building specific architecture for the data center.
Okay, let's drill down on MonTitan. It sounds like a comic book villain, but management wouldn't stop talking about it. What is it, technically?
MonTitan is their PCIe Gen 5 and Gen 6 enterprise SSD controller platform. But to really get why it matters, you have to understand the problem in the data center right now:
Which is?
noise and traffic. In a modern AI server, you have thousands of SSDs. We aren't just talking about storage, we're talking about something called performance isolation. If one tenant on a cloud server starts doing a massive data dump, it can slow down the drive for everyone else. That's the noisy neighbor problem.
Okay.
MonTitan uses a programmable architecture, it's almost like a mini computer inside the SSD, to manage those lanes of traffic so that quality of service, the QoS, stays perfect. Lets the data center slice up the SSD virtually. This is way, way harder than making a controller for a laptop.
And are they actually selling this, or is it just a PowerPoint deck at this point?
They're in what they call end-user qualification now. They expect it to be 5 to 10% of revenue by the end of 2026.
5 to 10% doesn't sound like a lot.
But that 10% is pure gold in terms of margin. It's the highest-end stuff they sell.
Speaking of gold, let's talk about the boot drive. In the call, they were kind of dancing around the name of the partner. They just kept saying leading GPU maker.
Come on. It's obviously the green team. It's the dominant AI chip player.
So why does a GPU cluster even need a boot drive? I thought the GPU did all the work.
The GPU does the math, but the system needs a brain to wake up, to load the operating system, log errors, manage network traffic. Every single AI server rack has a boot drive.
It's like the nervous system.
Exactly. And unlike a storage drive where you just dump data, the boot drive cannot fail. If the boot drive fails, the entire $1 million rack goes dark. SIMO has been designed into the reference architecture for the DPU and switch platforms for this GPU maker.
That sounds incredibly sticky. Once you're designed into a server rack blueprint, they don't just swap you out for a cheaper part next quarter, do they?
Never. The qualification cost is way too high. Once you're in, you are in for the life cycle of that product generation. And that's what changes SIMO from a commodity cycle stock to an AI infrastructure stock.
They also dropped a tech spec that caught my eye. They mentioned a 4-nanometer PCIe Gen 6 tape-out scheduled for this year. Why do we need 4-nanometer for a controller? Isn't that overkill? It's like putting a Ferrari engine in a lawnmower.
It used to be. But think about the thermal density in an AI rack. Heat is the enemy. Moving to 4-nanometer isn't just about speed, it's about power efficiency. If you can reduce the wattage of the controller by, say, 30%, that's less heat the server fans have to dissipate. In a rack with 500 drives, that adds up to massive electricity savings.
So they're future-proofing themselves for the 2027-2028 cycle.
Yes. While their competitors are struggling to get 12 or 7-nanometer right, SIMO is spending the money on 4-nanometer. This signals to the market that they aren't just here to pick up scraps. They want to lead the technology curve.
Okay, I am seeing the bull case. Legacy competitors left, leaving them the mobile market, and they're using that cash to buy their way into the high-end AI rack. But let's go back to the financials. You mentioned the EPS miss and the margins. What's the catch?
This is the high-class problem that comes with that vacuum thesis.
Explain that.
Remember how the IDMs shifted focus to HBM?
Right.
Well, that means they aren't making enough standard NAND flash. The raw material is in shortage. So prices for NAND are just skyrocketing.
So inflation in the supply chain.
Serious inflation. Now, SIMO has two business models. Model A, they sell the controller chip, high margin, low revenue dollars. Model B, they act as a solution provider. They buy the NAND, stick their controller on it, and sell the whole module.
So in Model B, they're just reselling the expensive NAND?
Correct. And because their customers, the handset makers, are desperate for supply and can't get allocation from Samsung, they're asking SIMO to provide the whole module. They're saying, just give us the drive.
So SIMO has to go out, buy expensive NAND, and resell it. That pumps up the top-line revenue number.
But it crushes the gross margin percentage. Think about it. If I sell a $10 chip with $5 profit, that's 50% margin. If I sell a $50 module, because the NAND costs $40, with the same $5 profit, my margin drops to 10%.
That explains the guidance. They guided Q1 gross margins down to 47%.
Exactly. The revenue looks amazing because they're passing through the cost of the NAND, but the profitability percentage takes a hit.
Is that risky? I mean, they're taking on inventory risk. What if NAND prices suddenly crash?
That is the biggest bear case for sure. If they buy a bunch of NAND at high prices and the market softens, They're stuck holding the bag. However, right now, the shortage is so acute that basically everything they build is already sold.
So the mixed quarter was basically we sold a lot more stuff, but a lot of it was low margin pass-through revenue.
That is the nuance. And management was very defensive about this on the call. They kept saying, look at the gross profit dollars, don't look at the percentage. And to be fair, gross profit dollars did grow, but Wall Street hates margin compression.
But they tolerated it this time.
They tolerated it because of the reason for it. The reason is massive demand. If your margins are down because you're slashing prices to move inventory, that's death. If your margins are down because you're shipping so much product you have to bundle components, that's a growing pain. The market sees this as a growing pain.
Okay, let's zoom out. We have this tension between a booming top line and a squeezed margin profile. We have a stock trading near highs. What's the signal for the listener who isn't, a day trader?
The signal is that 2026 is a transition year. Management explicitly called it a record revenue year. And when a conservative CEO says that in February, you have to listen.
They're putting their reputation on the line early.
They are. The market is betting that by the second half of 2026, two things happen. One, the MonTitan, the AI revenue starts to kick in, which is very high margin. And two, that the NAND pricing stabilizes. If those two things happen, you get margin expansion on top of record revenue. That's the Goldilocks scenario.
And if NAND keeps spiking,
then the stock probably churns here. The risk is that the pass-through costs eat up all the profit growth, and we get a kind of profitless prosperity scenario.
that brings us to our favorite segment. We've looked at the fundamentals. Now it's time to get a little speculative.
Let's do it.
This is not financial advice segment. We are going to pitch a trade idea that exploits the mechanics we just discussed. It needs to be plausible but aggressive. What have you got for us?
Okay, I'm calling this trade the NAND parasite spread.
I love the name. It sounds gross. Break it down.
The thesis is simple. SIMO is the parasite feeding off the inefficiency of the big memory makers. The memory makers are creating a shortage to chase AI, and SIMO is winning the volume. But there's a victim in this story.
Who's the host body that dies?
The generic hardware OEM, the mid-tier PC maker, or the white box server builder.
Explain the pain point for them.
These guys have zero pricing power. They sell laptops for $600 at Best Buy. They operate on razor-thin margins. And suddenly, the price of the SSD, which is a huge part of their bill of materials, their BOM goes up 40% because of the NAND shortage we just talked about.
And they can't raise prices on the consumer.
No, because the consumer is weak. So they just have to eat that cost. Their margins are going to implode.
So the trade is a pair trade.
Correct. We go long Silicon Motion, SIMO. Specifically, I'm looking at January 2027 call options, maybe slightly out of the money. We want to capture that second half 2026 ramp where MonTitan really kicks in.
And the short leg.
We're shorted a basket of consumer hardware OEMs. Pick your favorite generic PC box mover who doesn't have a big services business to save them.
So you're betting on the supplier of the scarce component and betting against the guy who has to buy it.
Exactly. It's a margin capture trade. You are betting the value transfers from the box maker to the chip maker.
That sounds logical, but let me poke a hole in it. What if consumer demand is so bad that they just stop buying laptops entirely? Then SIMO's volume dries up too.
That is the risk. If the macro economy really tanks, the vacuum doesn't matter because there's no food on the floor. But SIMO has the AI buffer, the PC maker has nothing.
Is there a kicker? A wild card?
There is. Vertical integration.
How on?
We talked about the leading GPU maker. What if they decide that the storage controller is just too critical to leave in the hands of a third-party partner, even a good one, like SIMO? They might just buy them.
M&A.
Yeah. SIMO is a roughly $4 or $5 billion company. To a giant like NVIDIA or Broadcom, that's pocket change. If rumors start swirling that the boot drive supply chain needs to be secured via acquisition, those January 2027 calls could re-rate 100% overnight.
So you have a fundamental floor driven by the mobile vacuum and a speculative ceiling driven by AI M&A.
That's the setup.
The NAND parasite spread. I
Right.
like it. But again, for the record, this is not financial advice. We are just two people talking into microphones. If you trade options based on a podcast, you are asking for trouble.
Please do your own homework. The options market is a dangerous place.
Let's wrap this up with some final takeaways. If you are holding SIMO or looking at it, what are the 3 things to write on a sticky note?
Number 1, ignore the EPS miss. It's noise. Focus on the Q1 revenue guidance. That counter-seasonal growth is the signal that they're winning real market share.
Number 2,
Watch the mix. They're winning in mobile now, which is great, but the valuation expansion depends on MonTitan and the enterprise side. We need to see that hit the 5 to 10% revenue target by year end.
And number 3.
Margins. This is the danger zone. Watch the gross margin percentage in the next report. If it dips below 46%, the pass-through problem might be getting out of hand.
I want to leave our listeners with a provocative thought to chew on. We talked about how SIMO is winning because the big guys left the room, but what happens in 5 years?
That is the existential question.
If AI computing requires total, absolute integration, where the GPU, the memory, and the controller are all fused into one single piece of silicon, does the business model of an independent controller maker even exist in 2030?
It's a valid fear. I mean, Apple killed the merchant controller market for phones by building their own. If the data center goes the way of Apple, SIMO has to evolve or die.
They're eating well today, but winter might be coming in the next decade. And that's why they're racing to 4 nanometer. They have to stay ahead of that integration curve.
Adapt or perish. It's the history of the semiconductor industry, really.
On that cheery note, we're going to sign off. Thanks for listening to Talk Tickers. Keep your eyes on the tape.
And stay curious.